Hi everyone, welcome to my channel. In today's video, I'm going to share my notes on ARK's most recent In the Know series, Inflation or Deflation. This ARK's video features Cathy Wood, the CEO of ARK Invest, and Nancy Lazar, the chief global economist at Piper Sandler. They've discussed economic and market indicators, and they weighed in on inflation and interest rates. In addition, I also shared a little bit of my notes of an article from the Economist magazine, which I think complements some of the ARK's points. Now, without further ado, let's get started. So they first started from monetary side. They are arguing that Fed is late into raising interest rates, and these higher interest rates risk creating financial distress. Because firstly, other central banks in the world have been raising interest rates several times already for over a year. For example, Europe and Britain, and their annual prices rise 7.5% and 7% respectively, which is driven by the soaring price of commodities, especially since Russia's invasion of Ukraine. The Bank of England in May raised interest rates to their highest level in 13 years, which is the fourth consecutive rate hike since last December. And we are in a global economy, so it is global rates that drive our economy. Cathy said she was struck by the fact that the Fed is really focused on the US. She thinks that Europe is in recession and China and some other Asian countries are also facing recession. You might compare this to Fed's last tightening cycle, but the current situation is very different from 2016. That's when Fed's last tightening cycle happened. In 2016, the Fed were raising rates into an accelerating economy, and doing that did not disrupt markets or economic momentum. But today, the economy is already slowing, with company earnings started to get hit, and we already had a quarter of negative GDP. So the Economist article mentioned that the usual way to rein in inflation is to raise rates above their neutral level, thought to be about 2 to 3% by more than the rise in the underlying inflation. And that points to a federal fund rate of 5 to 6%, which is unseen since 2007. Rates that high would tame rising prices, but will induce a recession. In the past 30 years, the Fed has on only three occasions managed significantly to slow U.S. economy without causing a downturn. Does the Fed have the stomach to inflict such economic pain? Many economists advocate higher inflation because in the long run, interest rates would go up in tandem, lifting them further away from zero. If below zero, the rate would be hard to cut in crisis. Inflation is also already helping the federal government by shrinking the real value of its debts. Inflation that is stable and modestly above 2% might be tolerable for the real economy, but in the article's opinion, there's no guarantee that Fed's stand today can deliver even that, and breaking promises have consequences. It hurts long-term bondholders. It might also add an inflation risk premium to U.S. cost of borrowing, and every month inflation runs too hot, part of the hard-won credibility ebbs away. So the Economist article thinks that with recent falls in the prices of oil, used cars, shipping, probably means that inflation will fall in the coming month. So the good news is that inflation may have peaked at last. But the Fed's 2% target will remain a long way off and forcing agonizing choices on the central bank. Cathy and Nancy are also arguing that Fed is late to the game, and these higher interest rates risk creating financial strains. But they think that the inflation rate will be contained below 2%, and Fed is not going to be able to raise rates as much as they currently suggest. So next, the ARK's video talked about the fiscal side. It's already not looking good for our monetary side. Well, they think that fiscal policy is at risk of creating a recession potentially even more than the Fed does. So during COVID, we had a very aggressive fiscal stimulus. President Biden's excessive $1.9 trillion fiscal stimulus, which passed in March last year, added extra energy into an economy that was already recovering fast after multiple rounds of spending, and brought the total pandemic stimulus to 25% of GDP, the highest in rich world. The stimulus went directly into consumer hands. Indeed, we were able to spend it very quickly. And note, that is also very different than 60s and 70s, where there were sustained increases in government spending. And the fiscal stimulus gave consumer firepower to buy a lot of stuff, and then there's port disruption both in the US and in China, so that created a supply shortage. But now, the government spending is declining dramatically, which is actually negative 20% this year. So with stimulus checks gone, inflation up, which cut real purchasing power, now a lot of people are struggling as a result of this massive fiscal drag. Now let's look at the company level. There's a broad-based situation, especially in retail sector, where companies are facing a surge in inventories, which is the opposite of COVID time we just mentioned. Inventories usually do grow, but now they are much higher than they were before COVID. So for some well-managed and big companies like Target, Walmart, Home Depot, their inventories were up 42, 33, and 32% respectively. Have we ever seen inventories ever increased this much? Cathy doesn't think so. So she thinks the supply chain issues, to some extent, are disappearing for these companies. And then what about their unit sales? The unit sales have basically been unchanged for a year, so companies still feel good about their sales. But the point is, the economy is now reopening, and our incomes are getting squeezed because of inflation. Additionally, we are getting ready to travel or have been traveling, so we just don't buy as much stuff, and we are expecting to see sales go down. So these combined means that the demand is now weaker than supply. Inventories relative to sales is higher than before, and we are still importing. Nancy has data suggesting that there's a 40% surge in consumer goods imports, which will end up in inventories. So then, what will company do to deal with too many inventories? Price cut. Walmart just said they are rolling back prices. And how much will this situation hurt corporate profits and employment? Again, there's a comparison between COVID and now. During COVID, people were reluctant to work, so companies had to raise wages more than they otherwise would have. The US labor market is overheating, with wages growing at an average pace of nearly 6%. In the last year, when revenues were growing double digits, supported by all the stimulus checks, that was fine. The stimulus checks directly boosted corporate profits because we went to stores and spend it. But now, growth is slowing, and we don't have those checks anymore. So it used to be easy to get jobs, but now it's going to change. We are actually already seeing signs where companies are putting in place hiring freezes, and that's stage one. And stage two is that if profits continues to decline, we could see an increase in the unemployment rate. Plus, company profits are cyclical. They are tied to the overall economic activities. And currently, as we've mentioned, the economy is slowing down. When revenue growth is slowing, unit sales stalling, yet costs go up dramatically because of the companies hired a lot of people and raised wages, that is really setting up for a pretty significant decline in corporate profits. Additionally, when looking at the business confidence did actually drop in the back half of the 2021, and it dropped sharply in the first quarter of 2022. And stock market earnings, at least through the first quarter, was still up, but Cathy thinks that earnings will probably continue to decline from the first quarter. And then we look at corporate profits after tax adjusted for IVA and CCA. That is a very good measure of underlying profitability. Looking at the quarter to quarter at an annual rate percent change, that drop was 25% from the fourth quarter to the first quarter. And Cathy thinks that it has been a giant hat fake for corporations, and that's why confidence has dropped so much. And this will also eventually affect manufacturing activities too, because someone made all these stuff, and this will spread into other factors in addition to retail. So to sum up here, there's tightening into a slowing economy because global central banks have been tightening, Fed is tightening, and there's a very significant fiscal drag. Government spending is declining, and then companies have too many inventories and are already starting to cut prices. So Cathie and Nancy do think there will be a sharp slowdown in inflation, and it will be back down below 2% as moving through the end of the year. There are some other indicators as I mentioned. I'll just go through them very quickly. So used car prices are also down. Cathy thinks a lot of people bought extra car during COVID because they didn't want to take the mass transit. Now that the mass transit is open, they are selling into the used car market. And we are already seeing, in terms of the housing activity, we are already seeing some weakness in the housing activity. Then there's Treasury bond yield. The long-term Treasury bond yield was 3.2 and now is back down to 2.98 within a couple weeks, which is a very rapid move. Cathy said she thinks the 10-year Treasury yield in terms of this is what the bond market thinks nominal GDP will be doing for the next 10 years. So 3% nominal GDP growth over next 10 years means one of those two things. Either growth is disappointing or inflation is disappointing, or both. Since she's in the world of disruptive innovation and she thinks that unit growth is going to surprise hugely on the high side of expectations because disruptive innovation is becoming a much bigger base in the economy and inflation is going to turn down. And relating to this, Nancy mentioned manufacturing renaissance, where companies realize the important role of automation, digitalization in making the business more productive. And at the same time, we're also onshoring manufacturing into the US, which is now creating a lot of good jobs in the middle part of the country. So in terms of the capital spending, cyclically it's going to slow down, but secularly it will be strong. So short term we'll need to squeeze out inflation, but longer term they are pretty optimistic. And that's all I have today. Thank you for watching, and I'll see you next time.